Thank you for joining Market Insights. I'm Jack Thurman, president of BKD Wealth Advisors. Do you know what's happening with your retirement plan? For plan sponsors and participants alike, understanding plans and trends are vital. Today I've asked Steve Toomey, firm-wide leader of our Benefit Plan Consulting Division, to address some of the key industry trends that plan sponsors and participants should be aware of. Steve, what are some of the key trends and best practices you're seeing relative to retirement plan design right now?
Yeah, the design of a plan actually is becoming a key tool in ensuring that participants have every opportunity for a successful retirement outcome. And one of the key things we're seeing right now is the incorporation of auto-enrollment into the plan. And basically what that means is when an employee becomes eligible to participate in the plan, they're being automatically enrolled into the plan. And we are seeing that the Department of Labor thinks that's a great idea. In fact, they are recommending that be an option or a component of the plan. And about 50% of the large plans in the U.S. have either incorporated that or in the process of incorporating that. And typically, they're the leaders in plan design changes, so we would expect most plans over the next 5 years to have that feature in the plan.
Auto-enroll sounds pretty easy. Talk about something a little more difficult from the standpoint of increasing participant contributions.
Well, Jack, the next step is to ensure that the plan is designed in such a way that encourages employees to defer as much as possible. And if we look at where most traditional plans are today, they're designed in such a way that the plan sponsor will match, say, 50% of the first 6% that's deferred by the employee. So in essence, an employee is putting 9% away per year. But we are seeing changes in that now. So a plan may actually match the first 30% of the first 10%. And so you're putting 13% away versus 9% away, and that can become significant. For someone who's making $50,000 a year, and let's assume it's a 20-year period and the market's going up about 6% a year, that could mean an additional $73,000 into their plan at the end of that period of time. The other trend we're seeing is auto-escalation. And what that means is that every year the amount that is being deferred by an employee into a plan increases. So if I'm an employee and in year one I'm deferring 6%, well, the next year it automatically increases to 6.5% and then 7%, et cetera. And those are all great choices for plan design. Now, obviously an employee can opt out of both of those, automatic enrollment as well as auto-escalation.
Investment management's a challenge for those of us that have been in the industry for years. Now you have a participant managing money for their retirement. Talk about how plan sponsors can improve the investment management strategy for plan participants.
Well, as you might imagine, this has become a fairly big issue over the last several years, particularly because of what happened in the stock market back in 07 and 08. And so a little history might be in order. If I was a plan participant 10 years ago, really all I had to choose from were individual funds. I had to create my own portfolio, I had to monitor it, I had to rebalance it. So it wasn't really ideal, especially for someone that probably didn't have a lot of investment expertise. So the probability of successful retirement was very low. So what we saw is about 10 years ago, mutual funds actually came up with professionally managed choices. And what they're called are target date funds and risk-based funds. And really what they're designed to do is allow a participant to just select it, kind of set it and forget it.
Steve, there's been a lot of discussion about target date funds, whether they're good or whether they're applicable, the challenges of them. Tell us what concerns you might have on target date funds.
I think it really centers around education and understanding of what those funds are designed to do. And I'm going to go back to 2007. If I were an investor and I was planning to retire in 2010, well, I might have a target date fund that is titled 2010. My perception probably was, well, when 2010 got here or very close to that, that was going to be a very conservatively managed fund. The reality of the matter is those funds are designed to help people get through retirement, not just to retirement. So it was designed in such a way with the assumption that that person may need 30 years worth of income off of that, so it still had growth components. And in fact, most of these funds had between 50, 60, 70% exposure to the stock market at that time. So in 2007, 2008, when the market fell, people invested in these funds. They were just shocked at what happened to the value of their funds. So the education was a big deal back then. And what's happened since then is fund companies have actually created new target date funds, whereas the previous ones we called through retirement, these are to retirement. So if I'm today in 2011, if I am going to retire in 2015, I might have a fund that's a to 2015, and that means it's going to be very conservatively managed those last few years up to 2015, and it's not going to have a significant exposure to the stock market. But still, education is a big deal because you have risk-based funds, now you have target date funds, both through and to. Consultants need to make sure participants truly understand what they're investing in.
Steve, what other trends are you seeing relative to investment choices in retirement plans right now?
Well, Jack, the introduction of the professionally managed funds was a really good step in the right direction. And so what we're seeing is plans taking it one step further and tiering the actual investment choices. So tier one is what we're going to call the do-it-for-me tier. And what that simply means is participants are actually defaulted into a target date fund that corresponds to the date that they're expected to retire. And it takes all the decision making out of the process for them. And surveys have shown that about 3/4 of all participants say, that's what I want to do. I don't want to have to think about it. I want to put it in there, and I really appreciate the paternalistic attitude that my employer is taking. Tier two is for that participant that says, hey, that sounds great, but I want to have a little more involvement, and we're going to call that the do-it-with-me tier. And what we're seeing there is the creation, if you will, of asset allocation buckets. You'll have your U.S. stock bucket, your international stock bucket, you'll have your U.S. bond bucket, et cetera. And the decision that needs to be made is not which funds go into that, because the consultant's already determined that. The decision is what percent of my portfolio should be invested in that. And about 15% of plan participants are saying that's what I want. Now, the last group of participants, and it's only about 10% according to the surveys, they want absolute control. And so what we're doing there is setting up self-directed brokerage accounts where they maintain 100% control over how that money is managed, and it basically takes the responsibility away from the plan fiduciary to do that. But in general, what we're seeing is there are a lot of trends in this industry, and it's really important for a plan sponsor to be partnered with a consultant who's going to keep them informed about these trends, help them implement best practices, and basically help fulfill their fiduciary responsibility.
Thank you, Steve. As trends develop, which could impact our clients and raise questions, we will continue to provide these informational broadcasts. For more information about BKD Wealth Advisors, please visit our website at bkdwa.com. Thank you for joining us today.